A little while ago, I made a video where I showed a losing month in my trading, and a few of the comments caught my eye. You need to re-optimize. Time to re-optimize. So in this video, we're going to explore the thinking behind these comments and why I disagree with them. Hi traders, if we haven't met, I'm Lisa, a data scientist turned algorithmic trader. Now, the first thing wrong with thinking that the fix for a drawdown is the mindset. Drawdown is basically where you're not making higher highs in your equity chart, which is 99% of the time. For example, take a look at this chart here. The most recent high is here in the arrow, and then afterwards we are in a drawdown while we are waiting to make the next highest high in our equity chart. Real traders understand that we are going to be in drawdown 99% of the time. There's only 1% of the time where we actually are making higher highs in our equity chart. If you are trading a backtest results or a live trading results where every single week you are making higher highs, then run for the hills. This type of trading is going to blow your account because they are most likely using grid and or martingale, and you can wake up tomorrow with no money at all left in your account. So let's ignore those equity charts that look too good to be true and concentrate on real trading equity charts where you're not going to blow your account anytime. So let's zoom out and take a look at one of these equity charts. When you look at the bigger picture, like over 20, 30 years of trading, everything looks so smooth and perfect. Everything is going up. But if you really zoom into the detail and actually look at the periods of drawdowns, you'll notice a lot of these charts actually have 6 months, 1 year worth of drawdowns before you are making potentially new equity highs again. So we as traders need to accept that most of the time we are going to be in drawdown. Let's pick an example. Let's say you're a trend following type of person. You have a trend following strategy, and it really depends on your time frame. But generally speaking, Forex pairs generally trend about once or twice a year. So for the rest of the time, we are going to be in drawdown. So knowing that currencies only trend once or twice a year, if we are trading over 1 month and we are losing for a trend following strategy, that is perfectly normal. Being in drawdown for a month is perfectly normal. It is within the cycle of trending and range bound strategies. I urge you not to think that being in drawdown for a month does not mean your strategy is broken. Being in drawdown does not mean your strategy needs to be fixed. It's important to switch our thinking and our psychology from being in drawdown means something is wrong, it means I need to take action to fix this issue, and switch it over to being in drawdown is a natural cycle of trading. It is a perfectly normal to have flows in our equity chart to reach higher highs and stay for 99% of the time in drawdown. We as humans, it's natural for us to see something that looks like it is wrong, jump in, take action, because it makes us feel good. It makes us feel like, hey, there was something wrong. I took action on that. I did something to try to fix that. But it is much more effective as traders to exercise patience. Before we get into it, I just want to say a big thanks to Black Bull Markets for sponsoring this video. So if you're looking for a solid broker, Black Bull is definitely worth a look. They're a New Zealand FMA regulated broker in operation for more than 10 years, and your funds are held in different accounts than the company funds. What I personally like is that they're designed for people who want to actively trade. They offer an amazing 1 to 500 leverage, and you get really tight raw spreads. You get super fast execution, and they've got MetaTrader 4, MetaTrader 5, TradingView, and CTrader. So you can choose to trade manually or use robots to do the heavy work for you. They've also got different account types depending on where you're at in your trading journey. You can open a demo account if you want to test things out, or open 3 different ECN account types. You've got standard, prime, and institutional, where you can get spreads from 0 pips. You can trade Forex, commodities, equities, indices, and metals, a lot of different assets. So yeah, if you want a broker that offers free trading view plans and a VPS for active traders, Black Bull is worth a look. And I've dropped a link in the description if you want to check them out or try a demo. All right, let's get back into it. The second thing wrong with thinking that optimization is going to fix our drawdown is that optimization is the solution. Optimization is not the solution. Imagine you are building a house. The house needs to be able to withstand rain and hail and wind, and yet if you decide to build your house using straw, this is bad foundation. What optimization does is it is like putting a coat of paint on the outside of the house, on the inside of the house, hoping that the coat of paint will protect the house from rain and wind and all that. Optimization will not save a badly built strategy, just like a coat of paint will not save a house made out of straw. Now, there is nothing wrong with optimization, which is the process where you try to find the best settings that work over a particular date range on a particular currency pair and a particular time frame. You find the best settings that work over that period and use those settings for future trading. What I don't do is I don't grab random strategies on the internet and assume the optimization's going to fix those strategies, because when we are looking at a house, we don't know if the paint job on the outside is covering hidden problems with the house underneath. Was it made from bricks? Was it made from straw? We don't know. It's got such a beautiful paint job. So don't grab random expert advice and strategies online and just assume optimization is going to fix it. What I do instead is I build it right the first time round. And one of the aspects of building it right is using walk forward optimization. What walk forward optimization is, for example, let's take a whole bunch of data. Here I'm going to take 2 years of data. I'm going to find the best settings that work over this 2-year period, and then I'm going to take those settings and trade them for 1 year. And then I'm going to repeat the process again. I'm going to take the next 2 years, and then I'm going to take those settings that I found were the best and then trade it again for another year. I repeat this process many times, and then finally at the end I take all these green bits, all these live trading bits, and then put them together on one equity chart, which can look something like this. So when I'm trading live, yes, I might re-optimize my strategy every once in a while, but that is based on how I built it in the first place. If I built it using an out of a sample period of 365 days, then I repeat the optimization process again after 365 days. I am not going in and re-optimizing just because I feel like it, because there was a drawdown last month. Based on my past data and the way I built it, that is how I would re-optimize it when I am doing real live trading. Walk forward optimization is one of the key tests that I use in my own build process. So if you want to learn more about this, then I recommend you watch this video right here. Thanks. Bye.